When you're looking at appreciation, not all properties do appreciate in value. That's the sad truth about properties.
Appreciation is a bonus. So if my property didn't increase in value after 2 years or 3 years or even 5 years, my heart is not broken because I've been benefiting all these months.
Now, if you go to the bank today and you say that I want to invest my money, I want to invest, say for instance, 100,000. I have 100,000, or let's use something that would be practical with a property. I have 1 million right now and I want to put it in a bank. And my bank says that they're going to be giving me 10% guaranteed, right? So no matter what happens, they're going to give me 10%. So 10% of 1 million, that's 100,000. So annually, I know that I'm going to be getting 100,000 from this bank. Now, at the end of the first year, this basically means that I'll have my 1 million, I'll also have 100,000, right? Minus tax. Now, the problem becomes that if I'm saying that I'm taking this 1 million and I'm putting it into a property, what is the return that you're getting on that property? Now, a lot of people don't understand what returns are they getting on the property. Yes, they're happy that I'm getting cash flow and I have a property, but however, we don't know what is the return that I'm getting on the property. You find out that somebody took 1 million, however, they're only getting 5%, right? 5% is what? It's 50,000. Now, if you're only getting 50,000 from your properties, we haven't really considered how much your vacancies are. So if someone is not in the property, how much are you going to be spending on that property, or how much are you losing? You find out that at the end of the year, you only got 3% of your money back. Now, I hear somebody saying that, but you can't compare a property and an investment that you're getting at a bank. Now, this is what I want you to think, or how I want you to think. When you're looking at appreciation, not all properties do appreciate in value. That's the sad truth about properties. Not all properties will appreciate in value. You find out that the property that you purchased right now with that 1 million is in an area whereby that 1 million was the cap. Sometimes you even bought it above market value. Now, after 5 years or 10 years, you find out that the property can't be sold above what that 1 million was. Now, the problem is that if you're looking at somebody that put in their money into a investment that gave them 10%, after 5 years, they will have if we say 10%, right? 10% over 5 years is what?
10% of, let's do it via 1 year.
Yeah.
10% divided by 100 times the 1 million. Right?
Yeah. That's
Are you using simple?
Yeah, simple interest.
Simple interest times 5.
Yeah.
100 times 5, 500,000.
So that's 500,000, right? So you would have got the 1 million and the 500,000, right? Let's say, hypothetically speaking. Now, if you're looking at the property didn't appreciate with value, but you were getting 3%. Now, if you're putting that side by side and you're looking at it from that stance, you can already see that you're in a bit of a problem, because now you can't really, if you do sell the property, you're going to be making a loss because you bought it way above market value. Number two, throughout the years, you were actually holding on to a property that was only giving you 3%. Now, that's the reason why we always emphasize in that you need to understand the numbers that come behind your property. 2 ways of us running away from this cash flow negative properties.
We need to understand the business model when it comes to property investing, in a sense whereby
So the first one is understanding the business model, right?
Yeah.
Okay. Understand. Okay, sure.
In a sense whereby what do I have control of and what don't I have control of. Now, as a property investor, I can see that this property, and I can get the information right before I even buy, that X property in X area is generating X amount. And then now I can further do research, which is called due diligence, and understand how much are my expenses. So in that way, I'm able to then take a conscious decision, in a sense whereby I'm making cash flow positive. So I won't be buying emotional, whether it's in a good area or not. Because here's the thing, right? When it comes to appreciation, this is how myself and Lebo look at appreciation. Appreciation is a bonus. So if my property didn't increase in value after 2 years or 3 years or even 5 years, my heart is not broken because I've been benefiting all these months. But now look at it this way. If you were not benefiting all of these months, and now you are only sold that after 5 years it's going to increase in value, only to find out that after that 5 years it didn't increase, now it's a problem. Because now it goes back to that thing of people saying property investing is a long-term game. Does it mean that now I need to hold on to it for dear life, even though I'm bleeding money? I would have lost 580,000 for 20 years. Do they mean that when they're saying that property investing is a long-term game? No, it goes back to understanding the fundamentals, and then now we can strategically position ourselves. So in order to remove emotions, I would say that understand the business model of property investing. And if you want to know more about this, we will be talking about this on the 1st of April. I'm really excited, man, about it.
I'm also excited about this.
Yeah.
Right? So now, the other point, right, is that, number one, if you are purchasing the property at market value, especially when you're looking at your normal properties, if you are purchasing, we're not looking at commercial right now, we're just speaking at your normal, we're looking at your normal properties. If you are buying your property at market value, chances are the property is going to be running at a cash flow negative, right? Especially if it's in an estate. Because number one, expenses that you have is bond. The second expense that you have, it's your levies. The second one, it's your rates and taxes. Then you have your insurance. And then you have your management company that you need to pay. There's maintenance amount that you need to put aside in case anything goes wrong. Now, if you're looking at all of those expenses, they tend to get a lot, to a point whereby you also need to take out money from your pocket. I mean, we've spoken to a lot of people that don't even look at maintenance and management company. Just looking at the bond, the levies, rates and taxes, just these three, they taking them to a point whereby they are running cash flow negative. So that's something that I really want you to understand, that if you're purchasing the property at market value, you are probably losing money on your property. Now you need to really negotiate on your price. Now here's the thing about negotiating. If you don't understand at what point, or you can't justify that, why are you putting in a negotiation at, why are you actually putting in the price, the purchase price at this point, it brings a problem towards the estate agent, because they don't understand where you're coming from. And now if they don't understand where you're coming from, they're going to take you as a chancer. So now it's like, say for instance, right now the property is selling at 1 million and you are putting in an offer of 200,000. I mean, at that point, you can't really justify that. Why are you putting it at 200,000? Now, if you're able to list all of your expenses and show the agent that, you know what, if I'm purchasing the property at this amount of money, now I'm going to be running at a loss. Now, this would be like me taking that person's problems and bringing it into my particular property portfolio. Now, that's not what you want. What you want is to be able to gauge that at what price point, or what is the sweet spot for me to purchase this property in order for me to be able to run at a cash flow positive. Or if I'm going to be renting it out, make sure if I'm going to be reselling it, I'm making a profit.
Here's how I want to end off this live. Very controversial.
You're not ending it, right? Because you still need to do the question and answers.
Yeah, we're definitely doing that.
Yeah.
So Lebo, I would buy a cash flow negative property.
Yeah, maybe if
with your money.
No, maybe if you start your own thing somewhere where I'm not involved, then you can buy it. Cash flow negative.
I'd buy a cash flow negative with your money.
Okay, so now if you're saying cash flow negative, let's really understand what you mean by it.
I'm making a loss.
Can we increase? Is there no chances of me increasing the rent? Is there no way of me saying that I can make extra money?
Give me a chance.
No, I really need to understand, because when you're speaking about money, you're speaking about something different.
You're already taking my shares from Non-Wealth. Let me tell you. Let me tell you why I'm the co-owner of Non-Wealth.
Break it down for me.
So here's the thing, right? If I approach
now, this is the reason why you'd buy a property on a cash flow negative, right?
Yeah.
Okay.
So here's the thing, right? We went to go view a property, and then we understood that it's got 10 units.
Okay.
Right? It's got 10 units, they are approved. So now the agent is coming back to us and saying that here are the papers, it's approved. We even have water and electricity is prepaid. So what's happening here on this property is that it's 60% filled. Now when you're looking at it being 60% filled, that means we've got 6 people or families, and we're left with 4 that we can still fill up. Now, looking at it that way, now there's potential in you. Are you happy with that?
No, if there is potential, hence I was saying that if there is potential. I mean,
that's why you hired me, bro. That's why.
You're hired. And you'll remain hired. You'll remain hired.
So if the conversation is more of it being 60%, it was right at the breaking even, or let's just say that we're running cash flow negative of $500, and we already know that at 70% we'll start making a profit. That means you already know that you're in a sweet position. So when it comes to cash flow negative, we really need to understand the dynamics of what is happening there. That's number one. Another thing, but this one is a bit difficult, right? This one is a bit difficult whereby you'll find out that your tenants, so the person who was owning it sold it with the tenants that were living in there. But now the tenants were not paying how much the market is paying for rental. Now that one is a bit difficult because you need to be well aware that you're going to have that conversation with the tenants. The conversation that it might go even south whereby you need to take extra I won't say what you need to do, but extra precautions for you to secure your cash flow positive. So that's the only two ways that I personally would go into cash flow negative. Otherwise, I wouldn't.
Of course. Now let's do Q&A, right? So Palisa says that I just bought property and realized that I purchased above market value. Palisa, you know, the situation that you're in right now, I can really understand it, and I'm not going to be judging you, because when you're looking at property and how property was painted previously, property is painted as you could never go wrong with property, and property is
even
the best.
now, bro.
Even
Like
now.
a lot of people, when we speak, they're like, you guys are complicating property. It's simple, this thing.
Yeah. So I really understand what you're going through at this particular point in time. But now something that I really need you to understand in terms of going forward. I need everybody on this live, if you're going to be purchasing a property or you want to purchase a property, I mean, at some point you need to purchase a property, right? Be it that it's for investment or for yourself. Ask the agent for something that's called a Lightstone report. So it's Lightstone report, Light stone, right?
S-T-O-N-E.
S-T-O-N-E. So it's a Lightstone report. So what Lightstone report does is that it will tell you what the value of the property is. Now, if the agent is saying, because this is what happens most of the time, the agent will ask the person that's selling the property that how much do you want, right? Then the person will say that, no, I'm looking at getting, say for instance, 5,000, 50,000, 500,000 on the property.
Hey, I was ready to buy that one, bro.
I want 500,000 on the property. What the estate agent will do is that they will add in some more money onto that 500,000. So you find out that the property is registered or it's on property 24 for 560,000. Now, when you negotiate and you don't know what the true value of the property is, you're going to be looking at that 560,000 and say that I want to buy it at 540,000. Only to find out that the market value of that property is 500,000. Now, if you bought it at 540,000, you're in a problem. So just to cut away that problem, or everybody that's listening to this, I'm not expecting anybody from the 97 people in this live to be buying properties that are 105 now. I'm not expecting anybody from this live to actually be buying a property that's above market value.